Alwyn van der Merwe is Director of Investments at Sanlam Private Wealth, and he joins us now for some thoughts on stock picks for this year. It's that time of year where we do think, if I were to get into a company, what would it be? Good morning to you, Alwyn, and we've been talking oil this morning, and of course Sasol is one of those companies that people have to think about with the oil price going down by more than 50% in a short time. So I don't know if Sasol is one of your stock picks. It would be offering value to some people.
Yes, I think there's a natural tendency that people will look in areas where prices come down, and as you said, oil price down 50%. But I think one should remember what is the price that Sasol discount within its share price. And when we do our numbers, Sasol still discounts an oil price of about $70, and with the oil price Brent terms below 50 this morning, if the oil price doesn't return to the $70, Sasol, although it looks cheap on a price earnings multiple basis, still looks for us pretty vulnerable, particularly given the fact that in the short term, many of the shale gas producers, their cash cost is still pretty low. So in the short term, that supply can still remain on the market and keep the oil price under pressure.
Alwyn, you said Sasol still looks vulnerable, so on your list of stock picks for 2015, what doesn't look so vulnerable to you?
Look, it depends on the methodology that you follow. If you really have a longer term view, you can be a bit more contrarian and maybe look at some of the commodity producers. But the methodology that I followed in a kind of a shorter term environment, we just feel that you need to have a combination of value plus momentum behind a share. And then if you look at the banks, for instance, FirstRand, perhaps the more expensive one, but with a return on equity of 24%, it justifies the rating. We think that FirstRand is very well capitalized, can certainly still grow their advances, has got a fantastic execution track record in Africa, and they can continue with a very good earnings track record that they've put forward over the last few years. And therefore, FirstRand is one where we think it's certainly a safer bet if you want to go for safer bets in a slightly more volatile environment.
Alwyn, looking at some of the more less orthodox picks, shall we call them, one share that's been out of favor for some time is Anglo-American. A view that it didn't ride the commodities wave when it should have, and has now spent a lot of time trying to recover over-expansion in a time when the commodities boom was over. So is it time for them to come back into favour?
David, I think the big draw card for Anglos, to my mind, is simply just the valuation. Now, when you value a mining stock, I don't think it means a lot if you look at the price earnings multiple, because in a down cycle the earnings will be under pressure, and therefore your price earnings multiple is probably going to be high. The better way to look at mining stocks, Anglos in particular, is to look at the price to book valuation. And at the moment, Anglos trades at a 0.7 price to book. Now, if I go back, and you can clearly see that I've been in the markets for quite some time, this is the cheapest that Anglos has been since the 98 collapse in commodity prices. So simply just from a price perspective, I think Anglos is, might reward patient investors for just buying the price. I can also say that if you look at the assets within Anglos and compare that with the assets that they had a few years ago, I think the quality of the assets are in all likelihood better. And I think the balance sheet also reflects a more realistic valuation for those assets. So simply just on a price, and therefore also on a relative basis, I think for the patient investors, Anglos are likely to reap rewards in the next year or so.
Alwyn, I want to go back to the oil price and the impact that it has had on certain stocks. We've spoken about Sasol, but SuperGroup is one. Supply chain, transportation and logistics. Does the fall in the oil price just strengthen the investment case for SuperGroup?
Yes, I think if you just look at the developments over the last few months, for many of the South African Inc. stocks, the developments has probably been positive because as you say, the oil prices have come off, petrol prices have come off, and to some extent it's almost like a tax windfall for consumers and also for companies who incur a lot of cost in terms of managing that supply chain. Now, one of the shares that will benefit from that, and remember that SuperGroup also has got retail outlets, motor retail outlets. One of the shares that will benefit for that is SuperGroup. Again, you go back to valuation, so you've got a pretty decent story for SuperGroup. You've got a company that has got a decent track record in terms of operational efficiency. And then if you add the fact that SuperGroup is still trading at about a 20% discount to the market, I think it all adds up to another pretty decent pick in an environment that is starting to favor these stocks.
I'm not sure how much the oil price would affect a company like Astral, the chicken producer. They were in a very bad place about 6 to 8 months ago. They did bring in those anti-dumping regulations, although the chicken producers say they haven't really helped as much as they should. But certainly that share has recovered in the last couple of months. The revenue revenue equation is worked out, revenue cost equation for them. So has the market noticed this yet? Have you noticed it before the market, Alwyn?
Yes, whenever we value a company on longer term considerations, what we normally do, David, is we look at what we call a through the cycle margin. And that margin for Astral is about 7%. And of course, as a result of the problems that you've described with, let's call it dumping of chicken in South Africa, but more than that, I think one of the other bigger issues was that, of course, feed prices were pretty high and their margins were very, very low. So there were enormous amount of headwinds that faced the company 2-3 years ago. And when you value the company, you never know when it's going to turn, but we value it through the cycle margins. The value was certainly there. So we had it on our radar screen at about 100 Rand. It fell to 80, and then over the last year it went from 100 to 180. The question is, why should you still include it now? We still think that with the opening up of the margins, more so than the imports, that is the big story for Astral. And again, it's a well-managed company. So, despite the fact that the margins have opened up, we still think that there's scope for the share to do well. I think if you also look at just inflation for meat prices, that has gone up significantly, and normally chicken should follow that. So I think there's still some upside potential for chicken prices at a retail level, and they should benefit from that.
Thanks so much. That is Alwyn van der Merwe. He's a Director of Investment at Sanlam Private Wealth.